In this video, we're going to concentrate on common stock. So common stock is it's evidence of ownership, right? It's referred to as equity, right? But it is a residual income security. As I've mentioned in some other videos, you only get something if there's something left over. So the uncertainty with what you receive is a riskiness that common stock investors are willing to take. Just because you're willing to take it doesn't mean you like it, but that also means that if you're going to take risk, you're going to want to get a higher rate of return. And as we've seen in some other videos, common stocks over the last 88 to 90 odd years have averaged in the ballpark 10 to 11%. So shareholders are represented by a board of directors, right? That's who oversees the entire corporation, and they're doing that for the owners. So the amount of control that a person holds, especially in a very large corporation, is really minimal. So we need these individuals. There might be 10 to 20 or so people on the board of directors, and those people are there to act in our best interest, and they're looking forward to trying to increase the stock price, make sure the company's running well. So again, as far as control, again, if there's no dominant shareholder group, right, then management's going to be in control. So that's why we need to understand ownership. And if you look online, there's places like Yahoo Finance, you can find out two nice pieces of information. One is the percentage control of insiders, right? So of all the control, of all the shares that there are, what percentage is owned by insiders? Insiders are essentially management. The other thing that's nice to know is what is the percentage control by institutions? From an investor perspective, you would like this number to be bigger rather than smaller, because institutions are there to look after the profits and the value. Most of the institutions that we would be talking about are financial institutions like mutual funds and investment companies. They make money when their clients make money, so they're going to really be very protective of those profits, and they're going to have and exert their control, right? So depending on where you're at in the world, and they talk about this here a little bit later, we know that different economies, different countries have different ways of looking at control and ownership. They say here in Europe, banks frequently take equity positions, right? So they can exercise a lot of control over the companies more than they do in the United States. And they also say in Asia, you have the same kinds of things, right? So how do we look at returns? Well, the annual rate of return for a stock has two parts to it. Dividend yield, that's the return you get from the receipt of a dividend over a year. And then capital appreciation is what the price change has acquired. So if you look at our formula here, you have D1 divided by P0. This is the dividend. But the 1, what does that 1 mean? It just means the dividend at the end of the period. So if I wanted to know what return did I earn today for a stock that I bought a year ago, the D1 is the dividend that I was paid this year. I divide that by the price when I bought it. So what is the capital appreciation? It's the difference in price from when I bought it, P0, to today, which is P1, again, divided by P0. So this is just capturing in formula the components of returns when you buy stocks. So here we have a GE stock, starts out $30.55. They pay 93 cents in dividends, and they end with a stock price of $31.60. So the question is, what is the formula? And I'll leave this up to you. You can pause this if you want. Do the calculation and find out whether or not you get the right answer. And the right answer, I'll let the drum roll a little bit, should be around 6.5%. If you have the PowerPoint open and you look in the notes, you will see the formula right there that tells you how to calculate that. From 1928 to 2016, dividend yields were about 3.7, capital appreciation about 7.5. So that gives us what? That roughly 11.2. So if you're looking at total returns on stocks, let's dumb it down. So it was 11%, right? Then around 3.7 of that came from dividends, and the remainder, whatever that would be, 7.3% roughly comes from prices going up and down. One thing to note is that it really depends on the time frame, right? 1928 to 2016, that's 88 years. At the time of this video, we've had 4 total more years of events in the economy. And from 2016 to 2020, we had record growth in the dividends, or in the marketplace themselves with respect to prices and dividends. So again, depending on the time frame, I mean, they say the recent decade. The recent decade they're talking about is from 2006 to 2016. It's not the recent decade that we're sitting in right now. So what this means for us is, in general, stocks are a hedge against inflation. That means the average rate of return on stocks is going to be greater than the inflation rate. Now, there are some times, 73 to 81 was a rough time in our economy. Inflation averaged 9.2, but it was double digit a little bit. So there are times when it doesn't beat inflation, but a majority of the time it does. So if you think about the premium, what benefit do you get from investing in stocks? Well, you have choices of what to invest in. Let's just say you only have 2 choices. You can buy government bonds, or you can buy stocks. There's only 2 securities. If you buy stocks, on average, you're going to earn about 6.2% more, which the real rate of return, again, during that time frame, is about 8.3, right? So what does that mean for investing? So we have a little graph here to think about. So if you invested $1 in 1927, and this goes to 2016, in 2016, you would need $14 to buy what $1 bought in 1927. And if you don't think this works, ask your parents or somebody that you know is a little bit older. Ask your parents, what they were paid when they first started working. I think it will astonish you, compared to what it costs to live today, what our parents and grandparents could live on way back when. But the reason is not that things were, in quotes, more expensive or less expensive, but the dollar bought a lot more back then than it does today. So if you invested in government bonds, that same dollar would grow to $71. So the difference here is your real return in dollars. So you just subtract that out. That's $57 is the real return over inflation of investing in government bonds. If you invested in stocks, that would grow to $3,286. What's the difference? Well, the premium over government bonds, just subtract out 71, $15, right? Over inflation, again, it's $3,272. So you can see that over time, stocks have been a great hedge over inflation, but also if you want your money to really grow, you need to put your money in the stock market. And I think that's the end story here, right? If you look from beginning to end, stocks roughly earn around 10%. So here's the secret, right? Here's the secret that most average investors don't know. You don't need to earn 10% per year to get this kind of growth. What you need to do is you need to average 10% per year, right? So you don't need to get 10, 10, 10, 10, 10. You can get 10, then you can get 30, then you can get minus 10, right? It can bounce around. As you can see here, there is variability in your earnings. Sometimes they go up, sometimes they go down. But in general, the growth pattern is a very positive pattern. So what about variability? Here's how stocks are split out over those time frames. And if you look at the number, right, here's 0. What's the chance that you would make money? And again, I can't point to a number here, but I'm looking at, let me see if I get my pen to draw something here. I don't want to draw, right? From here, all of these are positive returns. Some of them, huge returns. There were some years where you had a huge positive rate of return. But what about negative returns? Again, look at all these positives here, even up to 20%. There's a huge number here. You can go down here. Once you get to negative 15, right? That's right here. There's very little chance that you'll get less than that, right? If you're looking at the towers here, right? You're roughly talking about what? 5 or 6 years where it was worse than negative 15%. So the point I'm trying to make here is that in the stock market, there's a much higher percentage chance that you will make money than lose money. And so investors in the stock market, again, this is my opinion, is if you're especially saving for retirement, you have to have money in the stock market, right? It's the chance of loss over a long period of time is almost 0. The chance of loss in any one year, there's chances, but the chances of double digit, right, is really, not that great compared to all the rest of the opportunities. So I don't want to beat that into the ground. If you look at bonds, we talked about safety. Well, look where the distribution is. The distribution is all piled together, right? So that there were when the returns were earned, again, lower returns, but in general, what? They all happened right around this 0 to 5% return. This is where most of the returns were. Can you lose money on bonds? You can, but very little chance of having less than a 0 return. If you think about another security that we talk about is a hybrid security, this is what's referred to as a preferred stock. It kind of looks like debt, but it also is like equity. So like debt, it has a fixed payment. It has a fixed dividend. But unlike debt, the dividend payment is discretionary, right? You're not obligated. The company is not obligated to pay a dividend, right? By the way, companies will probably never default on the preferred stock for lots of reasons. But in general, they don't have to pay. And in addition, because it is a dividend, it's not tax deductible to the corporation. So it's just a stock, pays a fixed dividend, right? And it's just not tax deductible. So there's a couple things about preferred I think that we need to mention. One is that preferred shareholders have a higher priority than common shareholders. So if you don't pay a preferred shareholder dividend, you can't pay a common shareholder dividend. So the idea of what we refer to as a cumulative preferred says that before a company can pay any common stock dividends, they have to pay all of the preferred shareholder dividends, including any that they've missed. Remember a second ago I said that they'll never miss a preferred dividend. If they do, it is a catastrophic event. Most of the time, preferred shareholders do not have any voting rights, right? So again, there are certain rules, obviously, that follow all securities. Cumulative acts a little bit like debt, acts a little bit like stocks. So how do managers approach preferred stock? They really look at it one of two ways. Either way, they don't look at it the same as debt or entirely as equity, right? So some managers view it as being cheap equity because the dividends are fixed and they're never going to grow. Now, whether or not the dividend is higher or lower than the common stock, they're really focusing on the idea here is that the dividends don't change. So they can plan on it. They know what they have to pay from time to time. On the other hand, managers can look at this as debt with a tax disadvantage, right? Got to make payments. If they make payments, but they don't get to deduct it from their income. So again, preferred stock isn't widely used. Most financial analysts, when they're looking at companies that have preferred stock, they add the preferred stock to long-term debt. So financial analysts treat preferred stock like it's a bond. They do that for their analytical purposes because essentially the way the rules are set, unless the company will never default or not pay their preferred dividend because of the consequences to their common shareholders. So again, that's the end of this video talking about common stock and preferred stock. Look forward to seeing you in the next one.